Dear viewers, hopefully you will find this lecture very well. This is our first lecture on advanced financial management. In this lecture, we'll talk about the review of fundamental concept in finance and accounting. So this is our basic lecture for the finance and accounting and advanced financial management. Now remember, this lecture is a revision lecture, so it includes the topic from chapter number 1 till chapter number 10 for the corporate finance. So the first thing we're going to understand or going to know about the corporate finance is the time value of money. Now the time value of money is an important factor in financial literature. Why we're investing money? If we invest money today, for example $100 we're investing today, and if we're getting the same amount of money, which is $100 after 4 years, would that be sufficient for us? Now of course, when you will be investing the money in the market, regardless of share market or any other investment, we will be looking for better return. Therefore the time value terminology has derived. So the FV is the future value, is the amount an investment is worth after one or more period. So for example, in year 1 you invested $100, so what will be the return, what should be the return you're looking for in year 1 or year 2, year 3 or 4? So what is the return of year 4 if you invest to the $100? And the present value is the current value of the future cash flow of an investment. For example, you invest $100 in a savings account that earn 10% interest per annum according to the question for 3 years time. So if you invest this amount of money, $100 today, for 1 year, after 1 year you'll be receiving $110. After 2 years the same amount of money will be $121. And if you want to invest this $100 for 1 more year, so after 3 years it will be $133.10. Now the future value of $100 after 1 year is $110. The future value of $100 after 2 years is $121, and the future value of 100 years after 3 years is $133.10. So what is the future value? How we calculate it? So the future value is FV, and T is the time, is equivalent to the current value today, say $1, multiply 1 plus rate. Rate is the rate what we're going to take, maybe it's the market rate, power T. T is the time, so how long you want to invest. So the expression 1 plus R power T is the future value of interest factor, or it's also called FVIF. For example, what will be $1,000 amount in 5 years time if interest rate is 12% per annum compounded annually? So this is the question, that what will be $1,000 in 5 years time? So we are looking for the future value of $1,000. So we put $1,000 here in the bracket. We've put 1 plus the interest rate, or we put the R, which is 0.12. Why 0.12? Why not 12%? Because 12 divided by 100 is 0.12, which is in percentage term. In the bracket we put power 5. Power 5 is the 5 years. So if you solve this equation, you will find after 5 years the amount of money you invested today, which is $1,000, will be $1,762.30. So if you do this question again, for example, now assume the interest rate is 12% per annum compounded monthly. Now in this example we look, the amount was compounded annually. Now the interest rate is compounded monthly. Now it will have an impact on the calculation. Let's look at it. Always remember that T is the number of compounding period, not the number of years. So for the future value of $1,000 for 5 years time, compounded monthly will be 1000 multiplied by 1 plus 0.01 power 60. Why 0.01? Because interest rate was 12%. Now remember, it is compounded monthly, so it's divided by 12, so it is basically 1%. Then if you divide it by 12, then your monthly compounding became 60. So 60 should be, basically how it has been calculated is 5 years 12 months. So 12 multiply 5 is 60. So if you solve it, is $1,000 multiply 1.8167, it will be $1,1816.70. So that is the future value of $1,000 if it is compounded monthly. So if you compare it in here, in the first example, the future value is $1,762.30, and in the second example it is $1,816.70. Which is better? Think about yourself. Whether the compounded interest rate or the simple interest rate. So the top one we call the simple interest rate, and this one is called the compounded interest rate. Now in this table it is showing the future value at the different interest rate. Just look at it, you'll find that what are the different interest rate and what is the future value of $100 in next 5 years time. So this is the number of periods, which is annual, so here 1, 2, 3, 4 and 5, and this is the percentage of return or interest rate. So for example, if you want to invest $100 today, after 1 year at 5% interest rate, it will be $105. At 20% interest rate, it will be $120. If you want to invest $100 for 5 years, which is 5 years here, at the 5% rate, it will be $127.63. At 20% interest rate, it would be $248.83. So we understand the concept of future value, and we also understand the concept of present value. So the present value you need, say for example, $1,000 in 3 years time. If you can earn 10% per annum, how much do you need to invest now? So in this question, that you will be looking for $1,000 in 3 years time. And if you can earn 10% per annum, how much do you need to invest now? So discount in 1 year should be 1,000 multiply 1 plus 0.010 is 10% interest rate, power -1, because we are calculating backward. Instead of calculating front in the front, so we are calculating the backward. So it will be $909.09. The same way for the next year, which is discounting for the 3 years, it would be $751.32. And this chart is showing the present value at different interest rate. Present value at the multiple cash flows. So now we're calculating the present value of different cash flows at different point of time. So let's look at this example. You deposited $1,500 in year 1, $2,000 in year 2, and $2,500 in year 3 in an account paying 10% interest rate per annum. What is the present value of this cash flow today? So you are actually depositing $1,500 for year 1, $2,000 for year 2, and $2,500 for year 3. So what we need to do, what is the present value of this cash flow? So you need to discount back on 1 year at a time, and we need to calculate what is the present value of these 3 cash flows. So year 1 will be depositing $1,500, and which will be equivalent of $1,364 in present dollar term. Year 2, you'll be investing 2,000, so you need to have, so the present value of 2,000 in today's term will be 1,653. In year 3, you'll be investing 2,500 in present dollar term. The value will be 1,878 because the $2,500 it will be in the future dollar. Alright, so if you add all these things together, which is 4,895. So this is how we do it. So it's showing that year 1, year 2, year 3, year 4 and year 5. So year 0 is our current period. So what we are doing in year 0. So you're not investing anything, so it's the current period. So year 1 you'll be receiving $1,000, for example in this case. Year 2 you'll be receiving 1,000, year 3 you'll be receiving 1,000, 4 is you'll be receiving 1,000, and year 5 you'll be receiving 1,000. So next 5 years time you'll be receiving $5,000. So if your R is 6%, what is suggesting in here 6%, what is the present value of this $5,000 which you will be receiving at various points of different years? What is the present value of this amount? So if you calculate backward, so 1000 divided by 1 plus 0.06 power 1, it will be $943. So if you calculate all these things in the backward, you'll find these are the amount, or these are the equivalent amount in year 0. So if you add all this value, which will be $4,212.37, and this is the value of different cash flows, or the present value of different cash flows. So in the finance, the concept of annuity is also very important. So the annuity is an ordinary annuity. It's a series of constant cash flow that occurs at the end of each period for fixed number of periods. So you'll be receiving some amount of money every period. On the other hand, the perpetuity is an annuity in which the cash flows continue forever. So unlike the annuity where you'll be receiving a constant series of payment, or you need to do a constant series of payment for a number of years, in the perpetuity there is no time limit, so you'll be receiving it forever. So the present value of annuity is given in here in this formula. So C is the cash flow, PV is the present value. So present value will be equivalent to cash flow multiply present value factor, which is then the 1 minus 1 divided by present value factor divided by the R, and the present value factor has been shown in here. So let's look at this example. This will give you more idea. For example, you'll be receiving 500 at the end of each next 5 years. The current interest rate is 9% per annum. What is the present value of this series of cash flows? For example, so you need to calculate the present value of these cash flows. So the present value is the PV. You'll be receiving $500 at the end of each for next 5 years time. So $500, which is the cash flow. 1 minus present value interest rate factor divided by the interest rate. If you solve this equation, you will find the present value of this series of cash flow is $1,944.85. If you do use a calculator, say for example in this class we'll be using Sharp ELS735S calculator. So in that case, what you need to do is in your calculator you need to put the PMT, which is the payment, is 500, N is the number of years, which is 5, IY is the interest rate, which is 9%, and then you have to say compute the present value, and then you'll find the present value is $1,944.84. Perpetuity. perpetuity. The perpetuity, the future value of a perpetuity cannot be calculated as the cash flow or infinite. Now in the perpetuity, the future value is infinite and you'll be receiving the same amount of money after every term. So we cannot actually calculate the value of perpetuity like the ordinary annuity. So what is the formula? The formula would be for the perpetuity is the present value equivalent is cash flow, which is C divided by the rate of return in the market. For example, rate of return will be C divided by PV. So the cash flow divided by, or the cash flow divided by the PV. So for example, the cash flow is $10,000 and the present value of the perpetuity is $100,000. So what is the rate of return? So 10,000 divided by 1,000, 100,000 is basically as 10%. Or if you ask another question, that how much to invest to gain an annual stream of 10,000 at an R of 10%. So how much money we need to invest to receive $10,000 per year at the rate of 10% return? So the answer would be $100,000. Bond valuation. Now remember, the bond valuation is a critical factor. It's a very critical factor in finance literature, because remember two things. When we'll be calculating the price of a bond, we need to calculate two things. One is the present value of all the coupon payment what the bond holder will receive throughout the holding period, and second, the present value of the face value of the bond. So let's look at it. So for example, the coupon payment is 8%. The face value of the bond is $1,000. The bond will mature in 5 years time, and cash flows is like this. So every year you'll be receiving $80, which is 8% of $1,000. And at the end, year 5, you'll be receiving $80 and the face value. So when you'll be calculating the price of a bond, you need to calculate both of these things. One is the present value of all this coupon stream. So basically you need to calculate backward like this, and then you need to calculate the present value of the face value, and that is the price of a bond. So we'll, in this chapter, we'll also look the net present value and other investment criteria. So there are different ways or the methods of project evaluation. Now some of these methods includes net present value, internal rate of return, benefit cost ratio, payback period, and accounting rate of return. So we'll look some of this method of project evaluation. So the first thing we'll look is the NPV. So the NPV is basically is the initial outlay minus all the future revenue after cost, and that is the NPV. So if you look into the formula, so CO is the initial cash outlay of the project, and this part is the cash generating from the project. So let's look at this example. The initial outlay of this project is $1,100, which is in today's dollar term or the present dollar term. Revenue year 1, it will be $1,000 less expenses $500, so total cash flow will be $500. And year 2, the total cash flow will be $1,000. So if you do the backward calculation, if you want to calculate the present value of $500 in today's dollar term, which is equivalent to $54.55. If you calculate the present value of $1,000 today, because you'll be receiving $1,000 after the expenses in 2 years time, so the present value of 1,000 is equivalent of 800 $826.45. So if you add this value, 826.45 plus 454.55, then minus $1,100, which is the initial outlay, you will find so $181. This is a positive number, so this is a positive NPV. Somehow the NPV could be negative, and in those cases we should not go and invest on those projects. Now in this slide showing how you'll do the solution using the Sharp ELS calculator. This is for your own practice. Now in this slide is showing that how the NPV will be calculated in multiple cash flows. So the new product and development cost and return are shown in the table below. If the cost of capital is 16%, is the project viable? So the project will be investing for 5 years, so the project life is 5 years, so it has several development costs. So year 0 is 420, year 1 development cost is 320, and year 2 development cost is 154, and the return has been given in here. So from here, first of all, we need to calculate what is the net cash flow. So in the right hand side we are showing the net cash flow. So first one is negative 420. How we get this number? It is 420 minus, because this is the cost and return is 0, so negative, so the net cash flow is negative 420 because it's cash outflow. The return in the first year is $215, but the cost is $320. So 115 minus 320 is 105. So it's also a negative number, so negative cash flow. Year 2 also we have 70. So year 2 we have a positive cash flow of 71. Year 3 we have 420. Year 4 we have 240, and year 5 we have $160 positive cash flow. So how you'll get the NPV? So if you solve it, so if you look at the cash flows, and if you look at the rate of return, which is 16%, and then calculate using your calculator, you'll find then the NPV would be 20.5. so it's showing in here NPV should be 20.05. okay, so based on this calculation, what do you suggest? Whether an investor should go with the project or the investor should not go with the project? As the NPV is positive and showing it's 20.05, which is a positive number, so we should go with the project. Internal rate of return. So the internal rate of return is a discount rate that equals to the present value of future cash flows with the initial cost. So the internal rate of return is a point where the initial cash flows and cash received from the project will make the project zero. So it's not profitable, it's not loss. So IRR is compared to the recovered rate of return, which is K, and if the IRR is, or the internal rate of return is greater than the cost, then the project should be acceptable. But if the internal rate of return is lower than the cost, then we should not go with the project because there will be loss. So calculate the internal rate of return. Let's look at it here. So the initial outlay is $20,000, and year 1 the cash flow will be $50,000, year 2 the cash flow will be $100,000, and year 3 the cash flow will be $150,000. Market interest rate is 10%. Find out the IRR. So that's what we need to do. So we know the initial cost or initial outlay, we know the cash flow for 3 years, we know the market rate. Now we need to calculate the IRR. So it's just showing in here the initial cost is negative 200, and the cash flow is 50 for first year, 100 for second year, and 150 for the third year. So find out the IRR such as NPV is 0. So here is showing that IRR and IRR. We don't know what is IRR, but we need to take a number. So we need to take a number and need to calculate the NPV. Unless the NPV is 0, we need to redo it. Okay, so that's how we'll calculate the IRR. So if we take the discount rate 0%, you'll find the NPV is 100. So we know it cannot be 100 because the IRR that makes the NPV equivalent to 0. So it's an incorrect IRR. So if you take the 5% rate or IRR, you'll find the NPV should be 68. If you take 15% rate, you'll find IRR is 18. So we need to understand that the IRR is an 18, so it cannot be an IRR. So the IRR should be less, should be more than that, because that should the calculation need to make equivalent of 0. So if you do the trial and error method, you'll find the IRR is 19.44, where if you use 19.44 as IRR in this calculation, you'll find the NPV will be 0. So initial outlay is 200, which is today's dollar, and the total return from these 3 years will be equivalent to $200. So it will be plus and minus 200 plus negative 200 plus 200, so it will be equivalent to 0. So the IRR in this case would be 19.44. But when you are doing the calculating the IRR based on the trial and error method, it will take a long time. So the best solution would be you use a calculator, and Sharp ELS735S calculator is a good one for that. So if you use this following method, and it will calculate the IRR for you very easily. And in this slide is showing the different pattern of cash flows for different period, and you need to calculate the IRR and NPV. Now I would give this calculation to you for your practice. However, there are some problems with the IRR. The most interesting problem with the IRR is the IRR can have more than one negative cash flows and multiple rate of return. And another problem with the IRR is the projects are not independent, because the project could be the mutually exclusive investments. The second part of the investment criteria would be the benefit cost ratio. Now this is quite simple to understand. Now in the benefit cost ratio, what you need to do is you need to calculate the present value of net cash flows. Now that's what you did previously. So you look present value of the cash flows divided by the initial cash outlay. So it's also called the present value index, or also called the profitability index. So the decision rule would be you accept it if the benefit and cost ratio is more than 1, but you reject the decision if the benefit cost ratio is less than 1. So let's look at it here. So let's go back to the old example where the initial outlay was $1,100, cash is $500 cash flow in year 1, and year 2 the cash flow is $1,000. So we calculate that the present value of $500 is $454.55, and $1,000 is $826.45. So what is the benefit cost ratio? So the benefit cost ratio would be is 1281, which is the present value of the cash flows, 1281 divided by initial outlay, with the initial outlay is $1,100. So if you divide it, you'll find the answer is 1.165. Now the decision rule of the benefits cost ratio is accept the project if the project cost and benefit ratio is more than 1. Now this is certainly more than 1, and we'll accept this project. Now other methods of project evaluation. There are two other major non-discount cash flow methods that are used in the project evaluation, which includes the payback period method and accounting rate of return method. So we look both the methods to understand different ways of project evaluation. Now the payback period method, which is one of the most simplest methods of project evaluation. So the payback period is basically look for how long it's going to take your investment to generate sufficient cash flow in order to cover your initial cost. So let's look at this example. The payback period illustration is showing that the initial outlay is $1,000. Year 1 the cash flow will be 200, year 2 it will be 400, and year 3 it will be $600. So if you accumulate the cash flows, you'll find year 1 is 200 as is previously described. Year 2 it will be 600. How we get the 600? 200 plus 400 is $600, and year 3 is 1200. How we get it? So 600 plus 600, year 3 is $1200. So the payback period would be 2.2 divided by 3 years. How we get it? Because initial cost is 1000, so we need to understand that to cover the sufficient amount in this example it will take just above 2 years. So 200 plus 400 is $600, but the initial cost was $1000, so we need extra $400 to cover the initial cost. So year 3 will receive $1200, but we need only $400, so we say 1/3 of the year. So it will take 4 more months in year 3 to cover the cost. So the payback period will be 2 years and 4 months. The first advantages of the payback period is we do not need detailed analysis. So this is so simple that anyone can understand. The second advantages of the payback period is it is simple to calculate and simple to understand. You do not need detailed analysis. And third, it's adjust for the uncertainty of later cash flows. So it's adjust for uncertainty of the later cash flows. However, there are major disadvantages of the payback period as well. Number one is time value has completely been ignored, because time value is an important factor in finance, and the payback period method, the time value has completely ignored. It also ignores cash flows beyond the cutoff date. So if there is a cash flow after 3 years or after 4 years and the cutoff date is 3 years, it will ignore all those cash flows. And another problem of the payback period is it's biased against the long-term in your project. Now the discounted payback period method is almost the same, but it look for the time value of money. So other things remain the same. Instead of looking for just the cash flow, so we'll be looking for the present value of the cash flow. So for example, here the initial outlay is 1000, rate of return is 10%, present value of the cash flow has been given in here. So how long is going to take to cover the initial cost? So in here it is discounted payback period is just under 3 years, 2 years and then 3 years. So the initial cost is 1000, cash flow for 200 is 181 for year 1, $400 is the cash flow, and the discounted cash flow is basically 331, and $700 is the cash flow in third year, but the discounted cash flow will be 526. So if you add all this value, it will be more than 1000. So the calculation said that it will be just below 3 years. Accounting rate of return. Accounting rate of return is another method of project evaluation. So accounting rate of return provide a quick estimate of the project worth over its useful life. Accounting rate of return is derived by finding profits after taxes and interest, and ARR use profit rather than the cash flows, and it does not account for time value of money. So how do we calculate the ARR? So the formula of ARR calculation would be ARR is equivalent of average net profit divided by the average book value, and the average book value is initial investment plus the salvage value divided by the 2. So let's look at this example. In this example, we find it out that the net profit is $105. For the second year, the net profit is $30, and the third year the net profit is 0. So assume the initial investment is $240 and our target ARR is 15%. So we need to calculate the average net profit divided by the average book value. So average net profit would be 105 plus 30 plus 10 divided by 3, which is 45. So how we get it, the average net profit? So it has been given in the previous slide, 105 plus 30 plus 0. So divided by 3, 45. Average book value would be initial investment plus the salvage value divided by 2. So as we know, the initial investment is 240 and the salvage value would be 0 for this project. So 240 plus 0 divided by 2 is $120. So the ARR is average net profit, which is 45. Average book value is 120. Then you'll find the answer is 37.5, and our target ARR is 15%. So in this example, we should accept the ARR. So there are different advantages and disadvantages of the ARR. Now why we do the ARR? Because this is a method of project evaluation to understand whether the project is viable or not. So the first example of the ARR is it's easy to calculate and understand. Second, it considers all cash flows of the project. So unlikely like benefit cost ratio or no, so for example, unlikely like payback period method. It will not ignore cash flows after the cutoff period. However, there are disadvantages as well. So the first disadvantage is it's not the true reflection of return as the time value has been ignored. And another disadvantage is it determines of target average return on ad hoc basis. Third, it uses profit and book values instead of cash flows and market value. Now this could be a bit backdated or incorrect. So these are the disadvantages of ARR. So now we'll look at to the value. We'll look to the share price valuation and debentures. Now you must have learned the share price valuation. Now when we'll be talking about the share price valuation, we'll be looking for basically according to the textbook that we'll be looking for the different growth model. Now in the share price valuation, one important thing is we need to understand the dividend, because the dividend will reflect the share price. So if the dividend have zero growth, so what do you mean by zero growth? So if the dividend is paying the same rate forever, no growth at all, that is called zero growth. So in that case, if the D0 is say 5 cent, D1 is also the 5 cent, D2 is also the 5 cent, so it means there is zero growth. So in that case, the value of the share would be very straightforward, like a perpetuity formula, which is D divided by the R. So if you look at it here, so D1 is equivalent to D2, D2 is equivalent to D3, D3 is equivalent to D4. There is no growth. So the PO is the price of the share, would be D divided by the R. So it is exactly like the perpetuity formula. However, if there is a constant growth of the share, so the constant growth is, for example, 5% growth. So in that case, D1 would be equivalent of DO, which is the dividend of today's value, or dividend what the dollar, what the dividend in today's amount, multiply 1 plus G. So the G is basically the growth rate, say growth 5%. So what is the dividend of year 1 if there's say 5% growth? Say the dividend 1, so say for example the dividend of year 0 was say 10 cents, so 5% growth, it would be say for example 15 cents next year. That's how it will be calculated. So D2 would be equivalent of D1 multiply 1 plus G. So if you loop the formula, it will be, if you solve the formula at the end, you will find a PO is equivalent to DO multiply 1 plus G, which is equivalent to D1 R and then divided by R minus G. And let's look at the calculation. So company XYZ has just paid a dividend of 15 cents per share, which is expected to grow at 5% per annum. What price should you pay for the share if the required rate of return on the investment is 10%? So the required rate of return is 10%. The share will have 5% growth, and the company just paid 15-cent dividend. So PO would be 15 cent, which is DO multiply 1 plus R. R is the growth, sorry, 1 plus G. G is the growth, which is 5% per annum, divided by R is the rate of return is 10%, R 10% minus G. So the share price would be $3.15. However, the share price sometimes might have the non-constant growth. So for first couple of years it might have a super growth, say 20% per annum for 3 years. After that the growth will slow down to 5%. So how you will calculate the share price in that scenario? So let's look at an example. A company just paid a dividend of 15 cents per share, and that dividend is expected to grow at a rate of 20% per annum for next 3 years, and at a rate of 5% per annum forever after that. So based on this calculation, or based on this question, we can understand that the share dividend will grow at the rate of 20% per annum for 3 years, which is a super growth. After that the growth will drop to 5% per annum, and it will stay forever. Assuming a required rate of return of 10%, calculate current market price of the share. So that's what you need to calculate. So the formula is given in here, so we'll look at that. Now remember, in this calculation we need to calculate DT is the dividend of all this time, the dividend what we're going to get for 3 years, divided by 1 plus R per T. So we're calculating backward what is the dividend in today's dollar term, plus PN. So what is the terminal value? So if you look at the PN here, PN is expected terminal value at the end of period N, or the constant growth formula. So after 3 years, when the share will have a constant growth forever, what is the value of the share, or what is the terminal value of the share? And R is the interest rate per annum or per period. So let's look at it here. So first of all, we'll calculate the expected dividend. So first 3 years it has super dividend or super growth. Let's put it this way, it's a super growth. So first year dividend was 15 cents, then it has a growth of 20%. So first 3 years these are the dividends. So year 1 18 cents, year 2 21.216 cents, and year 3 is 0.259 cents. And then the share dividend will grow at the rate of 5% per annum. So that's what's showing in here. So here we need to calculate the terminal value of the share. Now how we calculate the terminal value? We know the dividend in this period will be 0.272, so which is D4, so it's 0.272 divided by R minus G, which is just a constant formula. So if you solve it, you'll find the terminal value of the share will be $5.44. So let's put all this information together. So these numbers have been taken from the previous slide. So 0.18, 0.216, 0.259. Exact number 0.18, 0.216, 0.259, and then the terminal value. Now and then you calculate backward. Now this and the terminal value is $5.44. That's what we calculated previously, $5.44, and it's end of the year 3, so about 3. So if you add all this value together, you'll find the share value of this particular share will be $4.63. Hopefully you understand. If you don't understand, please please go back to the previous slides and look at it. Hopefully you'll understand the calculation very easily. If you use the Sharp ERA73 calculator, you can use it, and the functions or which button you need to press to get the number has been given in here for your easy understanding. Now in this slide we look for the debt security. So how we'll calculate the debt security and how we're going to understand the debt instrument in the market. Now the debt security are issued in the company or the government, which is to borrow money from the public on a long-term basis. Bonds are usually issued by the government, and the debentures are secured and issued by the corporation. Notes are unsecured corporate securities. Now when we'll be talking about the debt instrument and the features of the debt instrument, there are a few features those we need to understand. One is the coupon payment. So the bond or the debt instrument will give you a coupon payment either annually or semi-annually. Every debt instrument will also have a face value, which also can be called the par value. Is the principal amount repayable at the end of the term. Every debt instrument will also have some coupon payment. It is the annual coupon divided by the face value. And it will have a maturity, so a specified date where it will mature. Now there are some relationship with the market risk and the bond market. For example, there is an inverse relationship between the interest rate and the bond value. So if the interest rate goes up in the market, then it will have an impact on the bond price. So if interest rate in the market goes up, the price of the bond will go down. So the same way as the interest rate, if the interest rate falls, the price or the value of the bond will increase. Now my question is to you, why? You need to understand why. The main reason behind this is because there is a relationship between them, and that's an inverse relationship. If the market interest rate goes up, because the bond are paying fixed coupon payment and fixed interest rate, you can say it that way as well. If the interest rate in the market goes up, but the bond coupon payment remains the same. So for the investor, they would like to invest in other instrument which gives them more return rather than the bond. And the same thing happens if the interest rate goes down. So the bond becomes more attractive, because the market interest rate are not very attractive for the investors anymore. So it shows you in here. So it's a bond price giving, so 600, 800, 1000, 1200, and so on, and yield to maturity. So bond price sensitivity to the interest rate. So if the market interest rate goes up, the price of the bond goes down. If the interest in the market goes down, the price of the bond goes up, and there is the relationship between the bond and the market interest rate.